Our next guest says your best offense, though, in this environment is a good defense. He's got some picks that could offer some downside protection. Let's bring in Kevin Mahn, President and CEO of Hennion and Walsh Management. Kevin, welcome back. Good to see you. We're going to talk a little more about Buffett, but if Buffett is buying, should I be buying? Of course, he's the definition of an optimist because he's a long-term investor and he's 89 or 90 years old. That's pretty optimistic.
It is. And I think if you look back to this past weekend and some of those exciting game sevens in both basketball and hockey, what we learned is that sometimes, as you correctly pointed out, Tyler, the best offense is a good defense. And that adage also applies to investing, particularly in a year that's marked by such heightened and sustained levels of volatility. Consider this stat, Tyler. Of the first 92 trading days of this year, 30 of those days have been marked by a move either up or down by more than 1.5%. That's 33% of the time, or 1 in every 3 trading days, we've seen a move by 1.5% or more. So rightly so, investors have become unnerved. So what do investors need to do in this type of environment to stay invested in equity so that they don't miss out on the potential recovery if and when that happens, but also give themselves some downside protection to help weather these bouts of volatility? And we think dividend-paying or defensive equities are certainly worthy of consideration.
You say that you expect the Fed to turn a little less aggressive after a couple of 50 basis point hikes here, maybe late in the summer, early in the fall. Why do you think that?
We know there's 5 remaining FOMC meetings this year, Tyler. They've all but telegraphed 250 basis points hike in June and July. There is no meeting in August, and then they meet again in September. At that point in time, being data dependent as they are, we anticipate that they'll see more slowing earnings growth, a slower economy, and certain inflationary pressures starting to subside. As a result, I would not be surprised to see them raise by just 25 basis points in September and perhaps increase the pace of their balance sheet reductions at that point in time. So if, in fact, the Fed turns less hawkish than many currently believe, that could actually help support stock price growth potential during the second half of this year.